Hello, my friends. My name is Tomasz Wisniewski, and I'm the chief analyst. I'm a director in Auxiliary Intelligence at Auxiliary Intelligence, and welcome on our today's webinar. Please confirm on the chat that you can hear me and that you can see first slide of the presentation, and we will start our video because we need to start as fast as possible because my friends, I have loads of materials for you, a lot of slides, a lot of knowledge. So please write on the chat that you can hear me and we will be able to start. Okay, thank you very much for confirmation, and without further ado, we need to start because really, I have a lot of knowledge for you because in today's topic, we will talk about the fundamental and technical analysis, so two ways to analyze the market. To analyze the market instruments, to analyze the assets. Before this, a small introduction because I don't know, maybe you didn't read in the mail, etc., etc. But you need to know who is teaching because it would be the best if the person who was teaching you had an experience on the real market, was a real trader himself, and that's me. So I'm on the market for 10 years. But I'm not only working on this market, but I'm actively trading on real accounts, and I'm sharing my analysis, my trades, my account during my seminars, webinars, videos. I'm recording daily videos where you can see all my trades. So everything is super transparent, and you can see that I have knowledge from practical trading on a real market. Which I think is crucial if someone wants to teach you about trading, because yes, there are many educators. They can read a book or two and then try to teach you using just the theory, which of course makes sense at some point because the theory is sound, and it helps you to understand the market. But in order to be a professional trader, you need practical knowledge from the real market, because real market is completely different than the stuff that you read only in books. So my friends, we had this first webinar with the introduction about the market. You know more or less what the Forex market is, so now let's move on with serious stuff, and I'm gonna show you basics of the technical and fundamental analysis. So when you open a platform, when you open an account and you start trading, you need to ask yourself a question: how will you trade actually? So uh, based on what you will open your positions, because of course you can trade based on something. It does not have to be like legitimate knowledge, etc. But in order to make long-term profits, it would be, and consistent profits, it would be nice to trade based on legitimate knowledge, experience, and legitimate way of trading. And this is where you can start looking for type of analysis which you will be using. So you can use technical analysis, you can use fundamental analysis, or you can use both in various proportions. So for example, you can use 10% of fundamentals and 90% of the technical analysis. It's up to you, to be honest with you. And after this webinar, I think you will be able to pick the way which suits you the most. Myself, I use technical analysis. I do have fundamental knowledge, of course, but in order to trade, I use mostly fundamentals. But I'm not saying it's the best way to trade. It's just the way that suits me the most. It's the way that I picked long time ago and I feel comfortable with, and it gives me profits. Simple as this. If something works, there's no reason to dramatically change it. Of course, you can upgrade it all the time and work on it, but I'm not willing to change it dramatically because it simply works. I have an edge over the market using the technical analysis. Okay, guys, so what is the technical analysis? So it's the way of trading which is based on three principles. And in general, it suggests that future market movements can be predicted with certain probability based on the historical action. And probability is the key word here, because you can trade based on probability and possibility. Unfortunately, many traders, they trade based on possibility, which is not the case, which should not be the case. It is the case, but should not. Traders should trade based on probability. Okay, so technical analysis is used on the markets with high liquidity. Liquidity means a lot of market participants, and we need a lot of market participants in order to see what traders are doing, because when there's a lot of traders and they are trading, they are leaving the mark on the street, on the market, right? Because they buy, sell, and you can actually see those transactions and movements that this buying and selling is causing. If you don't have market participants, if you don't have a lot of trades, if you don't have a lot of money involved, it's much harder to spot and to use the technical analysis. Foundations of the technical analysis are the same regardless of the type of the asset. It is universal. So you can use the same principle. The same principle you can apply on euro dollar, on currency market, and on silver, on commodity market, on Apple, the shares, the stock market. So this is the best thing ever, I think, in terms of the technical analysis, that the principles are the same, and you can use it on on many different types of instruments. Unfortunately, it is subjective. In a nutshell, market charts are creating some patterns, and when you spot one particular pattern, you can assume that the upswing is more probable, for example, or downswing is more probable. Okay, and there are various patterns that you can look for, and you can consider, and you can trade based on that. This is subjective because, for example, some people can see this pattern, but others will not see this pattern because, for example, they are biased about one side of the market and they want to sell all the time, and they will not spot anything positive on the chart because of their mind and problems with our brain, which is associated to trading. And I will discuss it tomorrow, not tomorrow, but on next webinar. I will be talking about money management and trading psychology, which is super important topic, and you should be learning a lot about the trading psychology and money management. Technical analysis contains many lagging indicators. What is a lagging indicator? It means that it's late, that it shows you a buy signal when it's too late and the price already went significantly higher. And it's also very broad, the technical analysis, and it has plenty of instruments that can be mutually exclusive. So, for example, in technical analysis, you have indicators, for example, right? And one indicator can tell you that the price will go up, other indicator will tell you that the price will go down, and other indicator will tell you to stay away from the market, okay, in the same time. I told you at the very beginning that it is based on three foundations. So here they are. So price has it all. Market action discounts everything. So everything is priced in in the market. Second one is that price follows trends. And third one is that history likes to repeat itself. And don't worry, I will explain you everything. So price has it all. It means that all the news, all the things from the fundamental analysis is already reflected in price. Why is it happening? It is because there's thousands and thousands of smart people, smart traders, who are constantly looking for this news and data. They have sophisticated software, ultra-fast computers, which are helping them in analyzing this data. And based on this data, and of course, you don't have an access to all the data, and you don't have the manpower to analyze all this data, but those people do this for you, or not for you, but for themselves. Okay. And based on the outcome of this analysis, they trade. So they buy or sell. So imagine you have those big banks, JP Morgan, trading floor of Goldman Sachs, etc., with all those Harvard, MIT, Stanford graduates and supercomputers, and they analyze all the data coming from the markets, all the inflation, GDP, earnings, net income, etc., etc. And based on this, they get a reaction buy or sell. If most of those supercomputers give the signal to buy, naturally the price will go up because there will be more buyers, more demand, and the price will go up. And technical analysis will see this. On the chart, you will be able to see that there is a demand for this instrument and the price is going higher. And without those supercomputers and diploma from Harvard, you will be able to see the market movement. You will be able to join this party and join this movement and buy. Okay, so everything is reflected in the price. Price has it all. Sometimes it's wrong. Sometimes it doesn't work. Like, for example, Brexit referendum. As you can see, this is British pound to American dollar. Ahead of the Brexit referendum, a pound was going higher. Here is the moment of the referendum. By the way, we were expecting that Brits will say no to European Union. We were having live webinars before the referendum, and we were warning our clients about the possibility of no and high probability, and it became reality. So we were right. But nevertheless, you can see here that most of the traders were wrong. So they were anticipating that everything will be okay. So they were buying British pound, but the decision was no, and the price collapsed. So it's not always like this, that price cannot make a mistake, or traders from those Ivy League universities, they cannot make a mistake. Of course they do. But most of the time they are right. Most of the time they are right, and it's nice to follow them. About following, second principle of the technical analysis is that price follows trends. Okay, and it is always more probable that trend will be continued than trend will reverse. Okay, remember, trend reverses only once. And that's the problem with retail traders, and I hope you will not have this problem. What is the problem of retail traders is that they go against the trend. They love going against the trend. Why is that? Because the potential reversal movement is very strong, and this is what attracts them. That in a short period of time, they will be able to earn a lot of money. But they forget one principle, very important principle, that trends are always more likely to be continued than reversed. And this drives us to a very simple matter, like how to make profits on the market. Well, it's really, really simple. It's not easy, but it's simple. Buy low, sell high, buy low. Yeah, guys, you can see that there is a start of a bullish trend here. Wait. Here. Okay, here's the start. Here is a triangle, by the way. Here is the start of a bullish trend, and the price goes up, correction, up, correction, up, correction, up, correction, up. Okay, you buy when the bullish trend starts, and you sell when it finishes. It looks really simple, but believe me, once you will have this knowledge and you will get rid of all those flows of the beginners, and you will get significant knowledge and experience. You will be able to spot those occasions easily, and trends are always more likely to be continued. As you can see, downtrend, price making lower lows and lower highs. Price is clearly going lower, which means that sellers have always bigger chances for success. Simple as this. But what's the problem with retail traders? Let me show you that retail traders will try to buy here, buy here, buy here, buy here, buy here, buy here, because what they see is always a potential for a reversal, potential for a reversal, potential for a reversal, but they forget that all the way those people who are making money are sellers. It's always smarter to join the winners than losers, and winners in that case are sellers. You can also have a sideways trend. Remember, we are talking about price following trends. Sideways trend is just range trading, so price is moving sideways from the horizontal resistance to the horizontal support. Like for example, here for a long time, we had trading in the range. The easiest way to trade in the range is to sell on the resistance many times, sell on the resistance, and buy on the support, buy on the support, buy on the support. It's what makes sense. Channel trading. So if the price is following trend, the price is following the uptrend, it means that the price is making higher highs and higher lows. Okay, it usually allows the price to create a channel. In this case, it's a channel up. Okay, in order to create a channel up, you need 4 points, 2 higher support, 2 higher lows, and 2 higher highs. And this allows us to create 2 points, and then you will have a channel up, and you will be able to buy on the support, buy on the support, buy on the support. You also can sell on the resistance, but again, it is going against the trend, which is seldom profitable, like you can see here. And here's an example. We have nice channel up formation, upswing, upswing, upswing. Every time you buy when the price is touching this support, you are making money. And really, it looks ridiculously simple. And it is, guys. Don't try to complicate trading because there's no point in trying to complicate the trading. You think that if traders have 6 screens and they are wearing fancy suits, it means that trading is complicated, but it is. It is not. Let's move on. Channel down. Price is making lower lows and lower highs. Simple as this. You follow this channel down formation and you make money. Look the power of trends. I remember this situation very clearly. This is American dollar to Polish zloty. The price was bouncing from a crucial horizontal support. This is a weekly chart, and look at this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 weeks of upswing in a row. The price went ridiculously higher. And many traders were saying like, oh my God, it's too much. Now from this point, we should see a reversal. Price cannot go forever, etc., blah, blah, blah. What they forget is that price loves to follow trends. Look at this. This is the same rectangle as on the previous chart. This rectangle is this rectangle. 12 weeks, okay, small correction, more, correction, more. Once the trend is established, you try to join the party, join the trend. Last principle is that history likes to repeat itself. Okay, so this would happen in 2 weeks ago and 4 months ago and 2 years ago and 6 years ago and 20 years ago. It's very probable that it will happen again, that we will react again. We fly to the space, we have electric cars, etc. But human emotions regarding trading and investing, they didn't change much. That's why we will make the same mistakes and the same decisions over and over again when trading. And that allows us to use the technical analysis, because when we see an upswing, downswing, correction, etc., we tend to act the same way. And this should be a huge weapon for you, because if it does not change, it means that it can help you in predicting market movements. So people tend to act in the same way, in a similar way, in similar situations. Okay, people don't like to change their patterns, so those patterns will repeat over and over again over time. Look at this, for example. What is this formation? Maybe we have some traders that that have big knowledge about the trading already. This formation, what is this? Okay, I will tell you later, but in the meantime, I have to tell you that, well, you probably see it, but as you can see, it repeated 4 times in a row, okay? So we had this upswing here, and then downswing, upswing, downswing, upswing, downswing. This formation is a flag. Flag is a trend continuation pattern, okay? So the main trend here was a downtrend because the price was making lower lows and lower highs. So we had this correction, then breakout of its lower line, downswing, beautiful sell signal. Correction, downswing, beautiful sell signal, correction, downswing. Just by knowing this one pattern, you would be able to make 4 awesome trades. You would be able to sell here, sell here, sell here, and sell here. Sounds good, right? The same, very similar situation. Here we don't have a pattern, but we have correction equality. So the price is in a clear downtrend because the price is making lower lows and lower highs. But in the meantime, we have corrections, correction, 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 correction. Those corrections were the same in terms of the depth, in terms of the number of pips, in terms of the number of dollars, let's say. So they were, let's say, around 100 pips. Okay, just by having this, by finding that there is a pattern here, that the market is making same movements over and over again, you are able to trade and use it in your advantage. The same here. I also remember this few years ago, excellent trade on Australian dollar to American dollar. And this instrument was having bearish corrections here. And you can see, and those corrections were more or less 70 pips. 70 pips, 69, 72, 69, 70, etc. And here we have 1, 2, 3, 4, 5. I think that back then the market did 12 the same corrections in a row. Can you imagine this? Just by being able to spot this on the chart, every time the market went 70 pips higher, lower, you bought, profit, bought, profit. Beautiful. Probably when you read analysis, watch videos, analytical videos, etc., you hear a lot about the support and resistances. Okay, so these are the places where the price is bouncing, or we have breakouts on those levels. Usually, these are very important places for this instrument because in the history, the price made some significant actions on that price. So what can be the support or resistance? So this can be significant latest low or high, or lows and highs. Those can be technical formation lines, like for example the neckline and the head and shoulder formation. Those can be geometrical levels, like Fibonacci's. Those can be psychological barriers, like for example round levels for one particular pair, like 1.19 for euro dollar, 1.2 for euro dollar. Those can be trend lines. Those can be moving averages too. Let's talk about formations, because I told you at the very beginning that the price is making certain formations, and based on those formations you can trade. And really, guys, believe me, we are just scratching the surface here in terms of the technical analysis. I am just showing you how interesting this topic is, how broad, and how many interesting, reliable tools you can find in the technical analysis. You have many formations, and here I will just use few of them. I will not even mention the indicators. It's the topic for the other webinar, but just to show you which way you can follow, and in which way you can develop, you can study yourself. Okay, so let's see formations. So price is making certain formations, like you saw the flag, which are similar, which repeat on the charts over and over again. And why it works? Well, some smart people from Harvard, MIT, and Stanford, etc., with supercomputers, they analyzed thousands of charts of different instruments for the past X years, a lot of years, and they found out that price is making patterns, similar patterns which result in certain actions. Not all the time, but for example, even if one particular pattern result in the movement to the downside, for example, in 52% of the time, it gives you an edge over the market because it's a flip coin, right? It's a coin flip. If you trade, actually, you can buy or sell. But if one particular pattern gives you 52 to 48 chance of the success, in the long term, after making 1,000 trades, you will be making profits. You have edge over the market. Okay, so here is the first of this formation this formations, which is head and shoulders. You can see that this is kind of a man here. Yes, hands. And here is the man. Yes, so he has a shoulder, he has a head, and he has another shoulder. And this formation gives you a signal to go down. Let's see a few examples. Price is going higher, higher, higher. Price is making higher highs and higher lows, then fails to make higher high, makes lower low, and makes lower high, and then lower low. So basically, just this principle. In the uptrend, price is making higher highs and higher lows. In the downtrend, lower lows and lower highs. So once we have this change from the higher highs and higher lows to lower highs and lower lows, that is a head and shoulder pattern, and it gives you a sell signal. For example, here. Or for example, here. upswing, beautiful head and shoulder formation, breakout of the neckline, and a sell signal, beautiful. Another one. It goes both ways, right? So you had a head and shoulder pattern which was promoting downswing, and you have inverse head and shoulder formation which is promoting an upswing. Here is the neckline of this formation and an upswing. Let's see in the real world. This is a beautiful example. I also traded this myself. Here is an inverse head and shoulder formation after a downswing, breakout of the neckline, and an upswing. And here was a head and shoulder formation and a downswing. So guys, it's not that those formations are present on many charts almost all the time. If you will analyze the charts now on Auxiliary platform, we have a lot of instruments. I'm sure that you would find a lot of trading patterns active right now. So it's not that you will spend 1 week looking for one pattern. No, you will spot them all the time because they happen and they work. They are reliable aids, helps for traders. Another example, downswing, inverse head and shoulder formation, and an upswing. There are also triangles, okay? Here is an example of a symmetric triangle. Price is inside of the symmetric triangle and is getting ready for the breakout. Here is a question mark because we don't care if the price will go up or down. We just trade it. Once the price will break the upper line, you buy. Once the price will break the lower line, you sell. And here is an example. Here is a downswing, then symmetric triangle, then breakout to the downside. You sell here and you have profit. Upswing, symmetric triangle, price breaks the lower line of this pattern, and downswing. Guys, I can say that it's really simple, it's really easy, it seems like this, but again, it is really easy. Don't try to complicate trading. Trading is pretty simple, and let's leave trading simple as it is. Here is an ascending triangle. That's a small variation of this of the triangle. So instead of the formation like this, we have horizontal resistance and dynamic support, and we try to break the support, the resistance, try to break, and eventually we break it. Here you have the buy signal and sweet, nice, fat profit. There is also descending triangles, so horizontal support, dynamic resistance, prices going lower, test of the support, test of the support, test of the support, test of the support, and boom, finally the support is broken and you have a beautiful sell signal. Okay, to sum up the technical analysis, again guys, we just scratched the surface here. There's a huge, this is a huge topic. Hopefully I will be able to show you more about this. But to sum up about the technical analysis, it should be based on putting together certain elements to get the whole idea of the future price movements. What do we take into the consideration later? I will show you on the last webinar from this cycle when I will trade live myself, and I will tell you what parts of the technical analysis I use. It's about, guys, probability, not possibility. Again, everything is possible on the market, but what you should trade is to trade probability, and those patterns, the technical analysis gives you an edge over the market because it sets the probability, it shows you the probability of one action. If you have a technical formation, the probability of the price going up or down is bigger, and once you will be able to spot it, you will be good. Guys, let's move on to the fundamental analysis. So what is fundamental analysis on the other hand? So fundamental analysis are all those numbers and news coming from the economic world, geopolitics, and from the uh, like broad finance world. Okay, so we have like macroeconomical data like GDP, inflation. We have data related to one particular asset, like for example, when you trade on the stock exchange, you have to analyze the whole industry, you have to analyze the company, profit, losses, financial report, etc. You have the policy of central banks, which is important, and I will focus on it as well. And all this together, this is fundamental analysis. So, in general, fundamental analysis is trading when you know all the data in macro, which is surrounding your asset, which is saying something about your asset that you want to trade. Some people say that it's rather investing than speculation. Well, I'm not so sure about this. Some may say that it's investing in value and that the fundamental analysis is more essential in stocks because you look for the company with the best value. And practically, it's about trading expectations. And you can beautifully see this now that stocks are on all-time highs, although economies are struggling and people are losing jobs, etc., because we are trading expectations about the vaccine and about the world recovering very, very soon. And also, we are trading based on the fiscal stimulus, of course. The thing with fundamental analysis is that you will never know more than anyone else. And if you will, that is inside trading, which is forbidden, right? So fundamental analysis is you analyzing the data and based on this, making your decisions. But this data is widely available. And if everybody knows it, most probably everybody traded it already, okay? That's why it's good for the technical guys, because if everybody traded this information, they already left the mark on the chart, and you can follow this, you can see this, and you can trade yourself. And in my opinion, you can trade without the fundamental analysis. What kind of data do you follow, my friends? So, for example, data from the job market, because if you trade currencies, you would like to see if the economy of one particular country is doing bad or good. You can see few data from the market. So, for example, non-farm payrolls, which was absolutely crucial here in the great financial crisis in 2007-8. Then everybody was watching non-farm payroll because they wanted to see the recovery. And most recently, we also shifted, and from let's say 2015 to now, everybody forgot about non-farm payrolls because it was clear that everything is good. But then we switched towards non-farm payrolls again during the Corona crisis because millions of Americans lost the job, and then we had the big recovery of the jobs. Here you can see unemployment rate. That's another data, right? So here is unemployment first crisis, then everything was okay, and then unemployment rate here in United States, and the same with Eurozone. You can see this crisis. Then we had another crisis in Eurozone from Greece and Ireland, Italy, etc. Mostly Greece. And then unemployment rate dropping, and then Corona crisis here. There is also an inflation. Inflation is important for the central banks, and it should be important for you because based on inflation, central banks decide about the interest rates. So that should be important for you. As you can see, inflation is really low. close to 1 in United States and 0, close to 0 in Eurozone. So even despite the fact that we are printing loads of cash, the inflation is not rising, which is very interesting. For example, in Venezuela, when they print cash, the inflation is like in 1,000%. But if your European Central Bank is printing money or Fed is printing money, the inflation is low. So you can see level of inflation. But what is the most important factor for currencies? What would be your choice? What would be your pick? What is the most important data for the currencies? Can you tell me? In your opinion, what is the most important data for the currencies? And I will see on the chat. Okay, what is my view on the U.S. stock market? Well, I'm trading on the Polish stock market, which is largely undervalued now. So that's why I have a few companies in my portfolio. But as for the American Stock Exchange, well, I think that as long as Fed will be printing money, the stock exchange will go up, because there's simply so much money on the market that prices will go up. Okay, so as for this, CPI, you say. CPI, yes, it is very important because, as we said, central banks, they look on CPI in order to CPI in order to decide about interest rates. So I wanted to talk about interest rates because interest rates are the key for the currencies, and we are here to discuss the forex market. And interest rates are close to the all-time lows on most of the currencies. And why interest rates are key? Because everything has its own price, yes, and even money has a price, which is interest rate. So, for example, if you have currency like Naira from Nigeria, or Polish zloty, or I don't know, Indian rupiah, probably interest rates are higher, which means that just by having this currency, you have additional money coming from the interest rates. These are called swaps. So if you're buying currency with higher interest rate and paying for it with the currency of lower interest rate, you will get additional money every night just by doing this. And by buying the currency with low interest rate, using the currency with higher interest rate, you will automatically lose money for it. So that's why, my friends, interest rates are absolutely crucial. And after the great financial crisis, when we stopped looking at non-farm payrolls, we started to look at interest rates, especially here. This is from United States. We had this period of interest rates rising, then drops. So this is, okay, let me remove this. This is the time where everybody was looking at non-farm payrolls. Then we started to look at interest rates. And now we look at non-farm payrolls again. I would like to just show you how the monetary policy, how the policies from central banks affect the market, because this will be the essence of you using the fundamental analysis. Okay, because there's not so many fundamental data that can trigger such volatile and directional movements like interest rates. So once you will be able to spot this and learn this and understand this, that will be a great first step to understanding fundamental analysis. So here is the rate cut decision from European Central Bank. Before the decision happened, which was here, the decision was announced, which was here. So you can see just the announcement, not actual decision, created a huge downswing. Why? Remember what I said at the beginning? Trading fundamental analysis is about trading expectations. Technical analysis at some point as well. Trading is all about trading expectations. Trading is about trading what do you think is going to happen in the future. All right? So, rate cut. Rate cut means is negative for the currency. Rate rise is positive for the currency. So here is a rate cut announcement and decision from European Central Bank. So, and this is euro dollar. So euro should go down, and it went down. During the actual decision, euro came higher and continue higher for some time, which is weird, but not so much, because what happened is market discounted this scenario. So we already knew that there's going to be a rate cut. If there was no announcement when the rate decision would happen, we would see a sharp drop. But that was expected. Another unexpected rate cut. You can see that market lost 220 pips in 8 hours. That is huge. That is super volatile movement, because traders were not expecting this. And when they joined, we lost 220 pips in 8 hours. But here we lost how many? 650 pips in a few days. 650. Another unexpected thing. Mario Draghi, who was European Central Bank president, announced 1.1 trillion quantitative easing program, which more or less means printing additional money, which should be negative for the currency, right? Printing money, and look what happened, 200 pips in few hours, 500 pips in few days. Do you see the pattern here? Do you see the pattern here? In those two things. I will tell you. There is an unexpected, super important fundamental news, fundamental announcement. We have shock. We have shock on the market. We have shock on the market. And what's next? What is next is you have an excellent trading opportunity, because it was such a shock that even you can sell here or sell here and you still can make money on the market. Why? Because after such an important fundamental shock, market needs time to adjust. Needs time to adjust. For example, recently the information about the vaccine from Pfizer. Indices went significantly higher. Even if you were late for this announcement, you could buy, and you would be on profit right now still, because the market adjusted more, adjusted for a long time. Here's another example. ECB decides to widen this program, to make it even bigger, this quantitative easing program. Here. So more printing. So you sell here, for example, or here because you are very late. But this is huge fundamentals fundamental news, real game changer, which will dictate the price for a long, long, long time. Another example here from the Norges Bank, who decided about Norwegian krone. This is American dollar to Norwegian krone, and they decided to lower rates. Okay, so in this case, American dollar should be stronger, and it was stronger. And even if you were late, you could still be making money. And this is recommendations that I was giving in my previous company for Polish customers in the brokerage house, and we even traded this. That was the recommendation, as you can see, volume, stop loss order, take profits, etc. All the risk disclaimer here. That was a very profitable trade. Just this, because there was a fundamental big news, interest rate decision. We waited for a small pullback here. Interest rate decision, small pullback. Then we sent the recommendation to buy, and after this, the price went higher. Another example from Reserve Bank of New Zealand, which cut rates from 3.5 to 3.25. Long time ago. Now interest rates are super low, and you can see this initial decision, shock for the market. It wasn't expected, and then you can easily trade, you can sell here, profit, 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 profit. Big fundamental news, guys, big fundamental news. Power of fundamental news. Bank of Canada cuts rates from 0.75 to 0.5. This is American dollar to Canadian dollar. So based on this news, Canadian dollar lost and American dollar gained in value, which is here. Even if you're late, you can, for example, buy here or buy here, and then you earn profit. This is pretty beautiful if you ask me. Last example, Riksbank from Sweden cuts rates and widens QE. QE is this quantitative easing, so basically printing money. You can see the initial reaction. Big fundamental news again. Even if you're late for this announcement, you can buy here, buy here, buy here, buy here. And then you are on profit. Profit, my friends, big profit. Okay? Thanks very much for watching this webinar. We are not finishing the webinar. I'm just finishing this fundamental part because I wanted to show you that we do have Twitter, and on this Twitter I'm publishing all this great data, all this great analysis videos that we have, and I highly recommend you to check my Twitter, to follow us on Twitter, because you will get this news real time. Like here, for example, Auxiliary Intelligence Twitter as well. I post trading ideas, I post videos, everything what you need for trading, really. Also, again, we have this 50% amazing bonus. If you want to start trading, I think it's worth to use additional bonus. Why not? If it's for free, I think it's worth to use it. If you have some questions, please, guys, write to us on support@auxiliary.com. There is a lot of guys which are waiting to help you to answer all your questions. And what? Disclaimer. We are not giving investment advices. Never, never, never. How can you get this webinar on replay? Well, contact support auxiliary, contact your sales, your client manager, and he'll provide you the link, because I will upload this webinar on YouTube, so you'll be able to watch it again. Okay, my friends, remember, wait, that on Thursday, I think on Thursday, let me check. when we have next webinar, I think it is on Thursday, December 10th. Thursday, manage your money like a boss, the secret to pro money management. So yes, we will have a money management and trading psychology webinar. Super important, and you have to attend this webinar in order to gain additional knowledge. Very important. No, risk management will be on Thursday. Today we had technical analysis and fundamental analysis. Risk management will be on Thursday. All right, thanks very much, my friends. It was a pleasure to be here. I hope you enjoyed this webinar. If you did, rate this webinar after the end. If you didn't, of course, also rate it. Say that it was rubbish and you expected something else. It's up to you. Great. All the best, guys. I wish you all the best and see you on Thursday. And good luck in your trading, of course.